Ever been staring at a price tag, feeling pretty good about, maybe buying something? And then you get to the register and gam,
Oh, yeah,
the number is just different. Like some phantom charge just appeared.
definitely. That confusion, it's real.
Okay, good. So you're not alone if you felt that. Let's unpack this feeling. Today on the deep dive, we're venturing into the world of price calculations with taxes.
Right. Specifically sales tax and value-added tax, or VAT.
Exactly. We've got some really interesting material that breaks down exactly how these things work.
Yeah, our goal today is really to cut through that confusion. We want to clarify the differences between these taxes and really get how they impact what you ultimately pay.
Right.
We'll be looking at everything from, the basics of sales tax to more complex stuff like discounts, overheads.
And even how VA works. Because that's like a fundamentally different system, isn't it? Tax collected at each stage.
Precisely. It's a different model entirely.
Okay. So the mission then for this deep dive, equip you, the listener, with a clear understanding, make you feel more informed, less overwhelmed next time you see these taxes.
Absolutely. So where should we start? The basics of sales tax seem like the logical place.
Yeah, it makes sense. We need those foundational terms. Cost price, CP. That's the seller's initial cost, right?
Exactly. Or sometimes called the basic price. And then there's the selling price, or SP. That's what the seller charges before any tax gets added.
Okay, CP and SP. Got it.
And, from the seller's point of view, they're obviously interested in whether they're making money.
Naturally. Profit or loss.
Right. Profit is when the selling price is higher than the cost price. Loss, the other way around. Simple formulas. Profit equals SP minus CP. Loss equals CP minus SP.
And they often look at percentages, right? Percentage of the cost price.
Yeah, that's key for them. Understanding their margins before taxes even come into play.
Okay. Now, this is where it starts connecting to what you see as a buyer, the list price.
Or marked price,
Yeah.
printed price, quoted price. Lots of names for it.
That's the price tag you see on the shelf. And this is where discounts happen.
Yes. And importantly, discounts are almost always calculated on that list price, not the seller's original cost.
Okay, that's a crucial point. It's a tool for sellers, basically.
Right. Attract customers, clear inventory, that sort of thing.
So once we have a selling price, maybe the list price minus a discount, then sales tax comes in.
Exactly. Our sources show it's calculated as a percentage of that selling price.
So the formula is
Yeah.
Rate of sales tax times selling price divided by 100.
Spot on. That gives you the actual amount of tax added.
So if you know the rate, figuring out the final price is just selling price plus the sales tax amount.
Or there's a quicker way, as the material points out. If the tax rate is, say, X%,
Right.
the total price is the selling price times 100 plus X, then divide the whole thing by 100.
Okay. Let's try an example. Make it concrete. Imagine buying shoes. Price tag says $850, and there's a 6% sales tax.
Right. So, step by step. 6% of 850, let's see, that's 51.
Okay, 51.
So the total you pay is the 850 plus the 51. That's 901.
Simple enough. And the direct method.
Just 850 multiplied by 100 plus 6, so 106, then divide by 100. Or just 850 times 1.06.
And that also gives 901. Perfect. Both methods work.
Yep.
Now let's flip it. What if you know the total you paid, including tax, and want the original selling price?
Working backwards.
Yeah. Say someone bought something for $702, and that included an 8% sales tax. What was the price before tax?
Okay, so that 702 is the original price plus 8% of itself.
Yep.
So if you call the original sale price X, then X plus 0.8X equals 702. So 1.08X equals 702.
And solving for X, you divide 702 by 1.08.
Exactly, which gives you 650. That was the original sale price.
And the direct method for this reverse
So
calculation.
you take the total price, 702, multiply by 100, and divide by 100 plus the tax rate. So divide by 108.
And that gives us 650 again. Okay, got it.
It's just rearranging that first direct formula.
Makes sense. Now here's one that feels even more like detective work. You see the printed price, you know what you paid. What was the tax rate?
Ooh, okay.
Someone buys face cream. Printed price, €70. They pay 79.10 at the till. What's the sales tax percentage?
Well, first, find the actual tax amount paid. That's the difference, right? 79.0 minus 70.
Which is 9.10.
Exactly. That 9.0 is the sales tax amount. Now, to find the rate, you asked, what percentage is 9.0 of the original selling price?
The original price being the euro printed price here.
Correct. So it's 9.0 divided by 70 times 100%.
Let's see. 9.10 divided by 70, that's 0.13 times 100. 13%.
There you go. The sales tax rate was 13%.
Okay, these individual calculations are clear, but shopping trips are rarely just one item, are they?
No, usually not.
So imagine buying, say, some sweets for $165, taxed at 6%,
Yeah.
and also toothpaste for $230, taxed at 10%. You pay with a $500 note. How much change?
Okay, a multi-item, multi-rate scenario. First, calculate tax for each separately.
Right. Sweets, 6% of 165.
Which is 9.90. So the total for sweets is 165 plus 9.90 equals 874.90.
Got it. And the toothpaste, 10% of 230.
That's 23. So total for toothpaste is 230 plus 23 equals 253.
Okay, so the total bill is 174.90 plus 253.
Which comes to 427.90.
So if you pay with 500, change is 500 minus 427.90.
That leaves 72.90 change.
And this really shows how different items can have totally different tax rates, even in the same basket.
Absolutely. Very common.
Okay, let's add another layer. What about things like overhead charges for the business or those discounts we mentioned earlier? How do they fit in?
Good question. They definitely add steps. Overheads are extra costs the seller has, right? Transport, rent, packaging, stuff like that.
So they add that to their initial cost price.
Essentially, yes. It becomes part of their total cost to get the item ready to sell. We call this the effective cost price sometimes.
Okay. And then discounts come off the marked price and tax goes on the final selling price. It gets layered.
Let's walk through one. Example 5 in our source. A trader buys an item for $3,600, spends another $1,200 on overheads, wants a 15% profit on their total cost. Then there's 8% sales tax on top for the customer. What does the customer pay?
Right. So first, the trader's total cost, that's $3,600 plus $1,200.
Yeah.
$4,800.
Correct. Now, they want 15% profit on that $4,800, so they need to sell it for 115% of $4,800.
1.15 times $4,800.
That's
$5,520. That's the selling price before tax.
Exactly. Now, add the 8% sales tax onto that $5,520.
8% of $540.20 is $441.60.
Right. So the final price for the customer is $5,520 plus $441.60.
Which equals $5,961.60. Wow, you can see how overheads and profit margins really build up the price before tax even hits.
They do. The buyer ultimately covers those costs plus the profit and the tax.
Okay, here's another combo. Example 6. Shopkeeper buys for $1,500. Spends 20% of that on overheads.
Okay, so overhead is 20% of $1,500, which is $300.
Right. Then they mark it up, sell it for $2,452.50, and this price includes a 9% sales tax. What was their actual profit percentage on their cost?
Okay, multiple steps again. First, let's find the selling price before tax.
Right.
We know $2,452.50 includes 9% tax.
So we do that reverse calculation. $2,452.50 times 100 divided by 109.
Exactly. That gives us $2,250. That was the selling price before tax.
Okay. Now, what was the shopkeeper's total cost? Initial $1,500 plus the $300 overhead.
So $1,800 total cost.
And they sold it before tax for $2,250. So their profit is $2,250 minus $1,800.
Which is $450 profit.
And the profit percentage is that profit, $450 divided by the cost, $1,800 times 100.
Right. $450, $1,800 is 0.25 times 100, 25%.
So a 25% profit margin. Interesting how you have to unpack the final price to see the underlying profit.
The tax is part of the final transaction, but not part of the seller's profit calculation itself.
Now, what about those sequential discounts? 7% off, then an extra 4% off.
Yes, those can be tricky if you don't apply them correctly.
Example 7. Computer set, catalog price, $45,000 first, 7% off, then 4% off the reduced price. Finally, 8% sales tax on the final discounted price. What's the sales tax amount and the final price?
Okay, step by step. First discount, 7% of $45,000.
That's $3,150. So the price becomes $45,000 minus $3,150, $41,850.
Correct. Now, the second discount, 4%, is calculated on this new price, $41,850.
Right. 4% of $41,850 is $1,674.
So subtract that. $41,850 minus $1,674 gives $3,176. This is the final selling price before tax.
Okay. Now, the 8% sales tax is on this amount, $40,176.
Yes. 8% of $40,176 is $3,214.08. So that's the sales tax amount the customer pays.
And the final price, the $40,176 plus the $3,214.08.
Key takeaway there. Sequential discounts apply one after the other on the new reduced price each time.
Absolutely crucial. You don't just add the percentages together.
Okay, one last sales tax puzzle. Working backward again, always bit brain bending.
Ready.
Dinesh buys something for $374. Now, this price was reached after getting a 15% discount on the original marked price and then having 10% sales tax added to that discounted price. What was the original marked price?
Woo, okay, reverse sequence. Let's undo the last step first. The 10% sales tax, the price before tax was Y. So Y plus 0.10Y equal 374.
Or 1.10y, well, 374. So y is 374 divided by 1 point near, which is 340. Okay, so 340 was the price after the discount, but before the tax.
Right. And that 340 came about after a 15% discount on the original marked price. Let's call the original price Z.
So z minus 15% of z equals 340. Or z times 1.15 equals 340.
So Z times 0.85 equals 340.
Exactly. To find z, we divide 340 by 0.85.
340 divided by 0.85 equals 400.
There it is. The original marked price was 400.
Phew. You really have to carefully reverse the order of operations there. Discount first, then tax. So when undoing it, undo tax, then undo discount.
Precisely. It requires careful tracking.
Okay, I think we've really wrestled sales tax to the ground. From basic calculations to discounts, overheads, working backwards.
Covered a lot of ground there.
Now let's pivot. Let's turn to value-added tax, or VAT. Our sources present this as, well, a more modern approach, something that's replaced sales tax in many systems.
That's right. The fundamental idea behind VAT is quite different. Instead of one tax point at the final sale.
It's collected incrementally throughout the supply chain.
Exactly. From raw materials, manufacturer, wholesaler, retailer, tax is collected at each stage. And crucially, it's a tax on the value added at each specific stage.
Value added, meaning the increase in price or worth at that step.
Precisely. And it's important, as you said, VAT isn't usually in addition to sales tax. It's a replacement system.
Okay, so how does that value added calculation work?
Well, the source gives a basic example. Say the VAT rate is 10%. A trader buys an item for 800. Implicitly, there's 80 euro VAT embedded in that price from the previous stage.
Okay.
Then they sell it for 11,150. They charge their customer 10% VAT on that, which is 115.
Right.
The VAT they actually send to the government is the difference. The tax they collected, 115, minus the tax they effectively paid on their purchase, 80.
So 115 minus 80, 35.
Exactly. And notice the value they added was 1,150 minus 800, which is 350. And 10% of that added value is 35. It matches.
Oh, okay. So the net tax paid by the trader matches the tax rate applied to the value they personally added.
That's the core mechanism. The source has a really helpful table comparing the old sales tax way with VAT. Let's imagine a 10% tax rate and a manufacturer starting with 600 of materials.
Under the old sales tax system.
Manufacturer sells for maybe 1,000. First dealer sells for 1,200. Second dealer for 1,450. Retailer sells to the consumer for 1,680. The sales tax 10% of 1,680, which is 168, is collected only at that final point. Government waits till the end.
Right, all collected from the retailer. Now, how does VAT change that flow?
Okay, same 10% rate, same prices. Manufacturer starts with 600 cost, sells for 1,000. They charge 10% VAT, 100 euro. Assuming no prior VAT paid, simplified, they remit that full euro. Value added, 400. VAT, 10% of 400, which is 100.
Okay, manufacturer pays 100 VAT. First dealer buys for 1,000 with 100 embedded VAT.
Yeah.
Sells for 1,200.
They charge 10% of 200 euro 20. Their VAT payment is tax charge 120 minus tax paid 100 for 120 value added. 200 VAT. 10% of 200, 200.
Ratchets again. Okay, second dealer buys for 1,200, 120 embedded VAT, sells for 1,450.
Charges 10% of 1,450 owes 145. Their VAT payment is 145 minus 120, or 25. Value added, 250. VAT, 10% of 250 is 25.
Still matching. Finally, the retailer buys for 1,450, 145 embedded VAT, sells for 1,680.
Charges 10% of VAT on 1,680 is 1,268. Their VAT payment is 168 minus 145 equal 23. Value added, 230. VAT 10% of 268.
Wow, okay, so let's add up the VAT collected at each stage. 100 plus 20 plus 25 plus 23.
That totals 168.
Which is exactly the same amount as the single sales tax collected from the retailer in the old system.
Precisely. That's a crucial insight. The total tax burden on the final consumer can be the same, but VA spreads the collection points throughout the chain.
And each business only pays tax on the value they added.
Correct. And this creates a kind of self-policing mechanism. Each business needs proof of VA paid by their supplier to claim it back, encouraging compliance along the chain.
Fascinating. Okay, let's try another practical VA example. Example 9. Shopkeeper gets a 30% discount on an item listed at $2,000, pays 8% sales tax, acting like input VAT here, on that discounted price.
Okay, 30% discount on 2,000 is 600 off, so purchase price is 1,400.
Pays 8% tax on that 1,400.
8% of 1,400 is 112.12, so that's the input tax paid.
Then they sell the item at the original printed price of $1,000 and charge 8% sales tax output VAT to the customer.
Right. 8% of 2,000 is 160. That's the output tax collected.
So the VAT the shopkeeper owes the government is output tax minus input tax.
Yeah.
160 minus 112.
Exactly. Which is 48.
And let's check the value added way. They bought for 1,400, sold for 2,000. Value added is 2,000, 1,400 is 600.
And the VAT rate is 8%. What's 8% of that added value of 600?
0.08 times 600, also 48. It works out perfectly. The VAT is truly on the value added by that specific shopkeeper.
It really demonstrates the principle clearly.
Okay, here's a reverse VAT problem. Example 10. Shopkeeper sells an item at its marked price of $7,500. Charges 12% sales tax, input VAT. We know they end up paying $180 in net VAT to the government. What was the price they originally paid, including the tax they paid then?
Okay, let's unpack this. First, how much tax did they collect? 12% on the 7,500 sale.
12% of 7,500 is 900. So they collected 900.
Right. We know VAT equals tax collected, tax paid. So 180 equals 900 tax paid.
That means the tax paid on their purchase must have been 900 minus 180 and 720.
Correct. They paid 720 in input tax. Now, assuming the tax rate was also 12% when they bought it, that 720 represents 12% of their purchase price before tax.
So purchase price before tax equals 720 divided by 0.12, which is 6,000.
Exactly. That was their cost before tax. The question asked for the price they paid inclusive of tax.
Right. So the 6,000 cost plus the 720 tax they paid.
Total is 6,720. That's what they paid for the item, tax included.
Okay, working backwards with VAT requires keeping track of input tax, output tax, and net VAT.
It does.
What if the tax rates are different for buying and selling? Example 11. Shyam buys for 10,000, pays 7% tax, sells for 13,000, charges 9% tax. What's the VAT remitted?
Okay, different rates make it interesting. Input tax paid, 7% of 10,000, or let's 700.
Output tax collected, 9% of 13,000 euro over at 11.70 euro.
The VAT Shyam pays is simply output tax minus input tax, 1,100, 7,700.
Which equals 470.
That's it. The VAT liability directly reflects the difference between tax collected at the sale rate and tax paid at the purchase rate.
Simple subtraction once you have the two tax amounts. Let's trace a product again. Example 12. Manufacturer sells a washing machine to wholesaler for 15,000. Wholesaler sells to trader, making euro 1,200 profit. Trader sells to consumer, making euro 1,800 profit. VAT rate is 8% throughout. What's the VAT from the manufacturer, from the wholesaler, and the final consumer price?
Okay. Manufacturer sells for 15,000, charges 8% VAT equals 1,200. As the first stage, assuming they remit the full euro 1,200.
Got it. Wholesaler buys for 15,000. Input tax implicitly 1,200. Sells for 15,000 plus 1,200 profit equals 16,200.
Right. Output tax collected by wholesaler, 8% of 16,200 equals for 16,296.
So VAT paid by wholesaler output 1,296. Input 96.
Correct. Now the trader buys for 16,200, sells for 16,200 plus 1,800 profit equals 18,000.
This is the price before tax for the consumer. The trader charges 8% VAT on this 18,000.
Which is 1,440.
So the final price the consumer pays is the 18,000 plus the 1,440 VAT.
Equaling 19,440.
And again, we see the VAT collected in stages. 1,200 from manufacturer, 96 from wholesaler. And the trader would pay 1,440, 1,296 equals 144. It all adds up.
It flows through the chain, with each party remitting tax on their specific contribution.
Okay, here's a more complex business reality. Example 13. Shopkeeper's whole year. Purchases worth $4,015,000, paid $38,000 total input tax on those.
Okay, total input tax is known, $38,000.
Their sales were mixed. $50,000 worth tax at 5%, $3,020,000 worth tax at 12%, and $45,000 worth were tax-exempt items. What's the total VAT liability for the year?
Right. Need to calculate total output tax collected. First batch, 5% of 50,000 euro of 2,500 VAT collected.
Second batch, 12% of 320,000 euro equals 38,400 VAT.
Third batch, exempt, so 0 VAT collected.
Okay. Total output tax collected equals 2,500 plus 38,400 plus 0 is to 40,900.
Now, VAT liability equals output tax, total input tax, so 40,900 minus the 38,000 they already paid on purchases.
Which leaves 2,900. That's their net VAT payment for the year.
Exactly. This shows how businesses have to track various rates and exemptions on both sides, buying and selling, to figure out their true VAT position.
Yeah, bookkeeping becomes really important.
Absolutely essential under VAT.
Okay, one final VAT example back to the distribution chain. Example 14. Distributor buys for 15,000, excluding tax. Sells to trader for 20,000. Trader sells to retailer for 22,000. VAT rate is 10%. What's the VAT paid by the distributor and by the trader?
Let's use the value-added method here. Distributor buys for 15K, sells for 20K. Value-added, for 20,000, 15,000, euro 5,000.
VAT rate is 10%. So VAT paid by distributor, 10% of 5,000 equals 500.
Correct. Now, trader buys for 20K, sells for 22K. Value-added, over 22,000, 20,000, and 22,000.
So wrapping this all up, if we boil it down, the huge difference is sales tax is usually that one-time hit at the end, the final sale.
Right, typically collected entirely by the retailer.
Whereas VAT is this incremental system, collected bit by bit at every step where value gets added.
Exactly. Manufacturer, wholesaler, retailer, they all participate in collecting and remitting a portion of the total tax.
And understanding this difference is, well, it's pretty crucial, isn't it?
Yeah.
Whether you're running a business dealing with the rules or just us as consumers trying to figure out prices.
Incredibly valuable, yes. It gives a much clearer picture of how prices are built and how government revenue is collected through consumption.
This has been a really, really helpful deep dive. We've gone through sales tax mechanics, VAT mechanics, all sorts of examples.
Hopefully demystified things a bit.
Definitely. So considering everything we've discussed today, all those calculations, the flow through the supply chain, here's something for you to think about. How might the wider economy be affected by a country shifting from a traditional sales tax system to a value-added tax? Think about things like overall prices, maybe how easy or hard it is for the government to collect the tax, potential impacts over the long run.
That's a great question. Lots of economic debate around the pros and cons of each system in practice.
Definitely some food for thought to take away.